welcome to the deep dive. We got some really interesting sources from you this week, especially that one piece about taking a $3,200 Social Security check.
Yeah, I saw that one.
And really making it work for you. They called it a freedom plan. That phrase definitely caught my eye.
It did, yeah. It's a compelling idea. And look, for this deep dive, what we really want to do is pull out the key insights from everything you sent over.
Right.
The goal is to help you understand, concrete ways you might be able to grow your money, maybe protect it a bit, especially with how things are economically right now.
And that $3,200 figure, it's useful to frame it, isn't it?
Absolutely. Just for context, the average Social Security benefit projected for 2025, it's around $1,973.60.
Okay.
So yeah, $3,200 is significantly more. We're talking about strategies for maximizing that larger amount.
Right. And we know you're looking for knowledge you can grasp quickly but still feel thorough without getting totally bogged down in jargon.
Exactly. No one wants that.
So consider this your personal shortcut to understanding these kinds of financial strategies. Okay, so where do we start? Inflation seems like the big one hanging over everything.
It really is, yeah. One of the articles you shared, I think it was Univision, rightly points it out as a major headwind. Basically, inflation just means prices go up, your dollar doesn't stretch as far, it erodes purchasing power.
And the Social Security COLA, the cost of living adjustment for 2025, it's 2.5%.
Right. And while that's something, the article makes a good point. The 2.5% might not actually keep pace with how much costs are really rising.
Especially for certain things.
Yeah, particularly things like healthcare, housing costs. Those often outpace the general inflation rate,
Okay, so that $3,200, step one is realizing it might not buy next year what it buys today. You've got to sort of plan for that leak in the bucket.
That's a perfect analogy, yeah. It's the first hurdle to acknowledge. So if that's the challenge, what's the very first practical step before we even talk growth?
Right, before jumping into stocks or anything fancy.
Well, the consensus from the sources really is you have to build a secure foundation first.
Okay.
It's like making sure the ground is solid before you put up a building. Otherwise, it's just too risky.
Makes sense.
Yeah.
So what does that solid ground look like? What are the key pieces?
Okay, so the Diario AS article really focused on two big things here. First, the emergency fund.
The rainy day fund.
Exactly. And their recommendation is pretty specific. Aim for 6 to 9 months worth of your essential living expenses.
6 to 9 months. That's quite a buffer.
It is. But think about it, especially for retirees. An unexpected cost, a big medical bill, maybe, or a major home repair that can really throw your whole plan off track if you don't have that cushion.
Yeah, you don't want one surprise to derail everything. Totally get that. Okay, that's the emergency fund. What was the second part of the foundation?
It's managing debt, particularly high interest debt.
Credit cards, things like that.
Exactly. If you're carrying balances on those, the advice is to really allocate a chunk of that Social Security check towards paying them down aggressively.
Why is that so critical up front?
Well, think about it. The interest you're paying on that debt, it's like an anti-investment. It's actively working against you trying to build wealth.
Right. It's guaranteed losses, in a way.
Precisely. So reducing that high-interest debt frees up your future income. It stops the bleeding, so to speak.
Okay, so priorities 1 and 2. Build the safety net, tackle the expensive debt. Once that's looking, more stable, then we can talk about growth.
Then you're in a much better position to start exploring those strategic investment options, ways to potentially, make that money work harder for you, hopefully outpace inflation.
Okay, good. Let's get into that. What are some of these avenues?
All right, so Cameo Financial brought up a couple of interesting ones. First, TIPS, Treasury Inflation-Protected Securities. They're government bonds, but the interesting thing is their principal value, the core amount you invest, actually adjusts based on inflation metrics.
Oh, okay. So if inflation goes up,
the value of your TIPS investment goes up too. It's designed specifically to help protect your purchasing power against that erosion we talked about.
Gotcha. That seems like a very direct way to tackle inflation risk. What else did they mention?
Dividend-paying stocks.
Okay, stocks that pay you back regularly.
Yeah. These are shares in companies that have a history of distributing a part of their profits back to shareholders, usually quarterly.
And the benefit there is?
It can provide a steady income stream. That regular cash flow can help offset rising living costs, acting as another sort of buffer against inflation's effects. Plus, you still have the potential for the stock price itself to grow over time.
Right, so potential income and potential growth. Okay, interesting combination. Any other major investment types highlighted?
Yes, the AARP piece talked about balanced mutual funds.
Balanced funds. What does that mean exactly?
It means the fund invests in a mix of different asset types.
Hmm.
Usually it's a combination of stocks, which aim for growth, and bonds, which tend to be more stable and provide income.
So it's diversification built right in.
Exactly. That's the core idea. Don't put all your eggs in one basket. Spreading the investment helps smooth out the ride.
And they mentioned a specific one, didn't they? The Vanguard Fund.
They did. The Vanguard Balanced Index Fund Admiral Shares, ticker VBAIX.
What stood out about that one?
Well, a few things. It has a pretty standard, consistent mix, roughly 60% stocks, 40% bonds.
Okay.
Crucially, had a very low expense ratio, just 0.07% per year,
Wow, that is low. Why does that matter so much?
because fees eat into your returns. A lot of similar funds might charge, 0.5%, maybe even 1% or more. Low fees mean more of your money stays invested and working for you over the long haul.
Good point. And the minimum investment.
It is around $3,000 last I checked. So for someone getting that $3,200 check, it could potentially be an accessible starting point for a diversified investment.
Okay, so a single fund, diversified, low cost, seems like a solid option to consider. Now, what about real estate? That often comes up in inflation discussions.
It does. And the sources you sent touched on it too. Real estate can be a potential hedge against inflation.
How so?
Well, historically, property values tend to rise over the long term, often keeping pace with or even exceeding inflation.
Uh-huh.
And if you own rental property, you might be able to increase rents over time as costs go up, providing an income stream that also adjusts somewhat for inflation. Plus, the property itself might appreciate in value.
So potential income, potential appreciation, potential inflation hedge. Got it.
Yeah, those are potential upsides.
Yeah,
Of course, being a landlord isn't for everyone, and real estate markets vary wildly.
true. Okay, so we've got TIPS, dividend stocks, balance funds, real estate. Lots of options. It feels like you need to keep learning, though. This stuff changes, right?
Oh, absolutely. That was another really strong theme in the materials. The power of continuous learning.
Yeah.
The financial landscape isn't static. The economy shifts, government policies change, markets go up and down. You really have to stay informed to make good decisions over time.
So it's not just about picking an investment and forgetting it.
Definitely not. It's about understanding why you chose it and being ready to adapt if circumstances change.
Where can people go for that ongoing learning? What did the sources suggest?
AARP mentioned things like financial workshops, reading reputable financial news, especially outlets focused on, sound long-term principles, not just chasing headlines.
Mm-hmm.
And importantly, potentially consulting with financial professionals. It's about consistently making an effort to understand what's happening and how it affects your money.
Right. An ongoing process. Now, you mentioned diversification with the balanced fund. Can we talk a bit more about why spreading money around is so important generally?
Yeah, definitely. Diversification is like a fundamental risk management.
Okay.
By putting your money across different types of assets, stocks, bonds, maybe some real estate, maybe even keeping some cash or equivalents, you reduce the chance that one bad investment sinks your whole portfolio.
So if, say, the stock market has a rough year.
Your bond holdings might hold up better, or maybe your real estate investment does okay. Different asset classes often react differently to economic events. It cushions the blows.
Okay, that makes intuitive sense. Don't rely on just one thing working out. Are there ways to make the growth we're aiming for more efficient, like from a tax perspective?
Yes, that's a crucial point the sources brought up using tax-advantaged accounts.
Like IRAs.
Exactly. Individual retirement accounts are a prime example. Depending on whether you go with a traditional IRA or a Roth IRA,
Uh-huh.
your investments can grow either tax-deferred, meaning you pay taxes later when you withdraw in retirement, or with a Roth, potentially tax-free.
Hmm.
You pay taxes on the money going in, but then the growth in withdrawals in retirement are typically tax-free.
Wow. So the government actually gives you a tax break just for saving for retirement in these accounts.
Essentially, yes. It's a powerful incentive. Over decades, that tax advantage can make a huge difference in how much wealth you actually accumulate.
Definitely something to look into. Now, all this info is great, but applying it, it feels like everyone's situation is a bit different, right?
Absolutely. And that's where professional guidance often comes in.
Talking to a financial advisor.
Yeah. While educating yourself is key, as we said, sitting down with a qualified advisor can be really valuable
Why is that?
because they can look at your specific life, your tolerance for risk, how soon you'll need the money, your income needs right now, your long-term goals, all of it.
Okay.
And then they can help craft a strategy that's actually tailored to you, not just based on general advice.
So they bring that personalization that, an article or even this deep dive can't quite provide.
Precisely.
Yeah.
It bridges the gap between general knowledge and specific action.
Okay. Makes sense. But say you work with an advisor, you get a plan. Is that it? Set it and forget it?
Not quite.
Uh-huh.
Another key takeaway was the need for ongoing monitoring and adjustment.
Checking in on the plan.
Yes. Life changes.
Right.
Your goals might shift. Your income might change. The economy definitely changes.
Yeah.
So the recommendation is to review your financial plan regularly. At least once a year is a common suggestion.
And what are you looking for in that review?
You're checking if your investments are still on track towards your goals. Maybe you need to rebalance, like if stocks did really well, sell some and buy more bonds to get back to your target 60-40 mix, for example.
Keeping the diversification in line.
Exactly. And just making sure the plan still fits your life and the current environment. It's a living document, really.
Okay, not static. Good to remember. So, pulling it all together, investing, managing Social Security. What's the overarching mindset people should aim for?
I think the most important thing is adopting a long-term perspective.
Thinking long term.
Yeah. Investing, especially in things like stocks, is generally not about quick wins. It's more like a marathon.
Okay.
There will be bumps in the road. Markets go up, markets go down, sometimes sharply. But if you have a solid plan based on your long-term goals and you stick to it with discipline, you're much more likely to ride out that short-term noise and hopefully capture the long-term growth potential.
So try not to panic sell when things look scary.
Exactly. Avoid making impulsive decisions driven by fear or greed based on day-to-day headlines. Easier said than done sometimes, but crucial.
Okay, that's really solid advice. So let's try to quickly recap the big takeaways from the sources you shared.
Sure.
First, really understand inflation and how it impacts your benefits. That's fundamental.
Got to know the challenge.
Then build that solid foundation.
Yeah.
Emergency fund first, then tackle high-interest debt.
A negotiable first step.
Okay. Then explore those investment options.
Yeah.
Things like TPS for inflation protection,
Uh-huh.
dividend stocks for potential income and growth,
Right.
balanced funds for built-in diversification, and potentially low costs.
Good summary.
Real estate is another potential piece of the puzzle to consider.
Potentially, yeah.
And underpinning all of this, keep learning, stay informed.
Crucial.
Diversify your investments. Don't put all eggs in one basket.
Absolutely.
Use those tax-advantaged accounts like IRAs to make your growth more efficient.
Big advantage there.
Consider getting personalized advice from a professional advisor.
Could be very helpful.
Regularly review and adjust your plan. It's not static.
At least annually.
And finally, maintain that long-term perspective. Think marathon, not sprint. Avoid panic.
That really captures the core themes, yeah.
Yeah.
This deep dive, hopefully, gives you a solid framework built right from the information you sent us for thinking about how to potentially take those Social Security benefits and turn them into a stronger plan for your financial future. Maybe even get closer to that freedom plan idea.
Right. So as you're listening and thinking about all this, what's the one strategy or piece of advice that really resonates with you right now?
Yeah, what jumps out?
Which part feels most relevant to where you are today and where you want to be? And maybe, what's one area you feel like you need to dig into a bit more? Either through your own research or perhaps by talking to a pro.
Good questions to ponder.
Definitely some food for thought there. Thanks for taking this deep dive with us.